Is Google a good stock to invest in? Hi, my name's Hamish Hodder, and today I'm going to take you through the motions of how we analyze the strength of a stock, how we work out whether or not a stock that we're looking into is worthy of investment at some point in the future. This is the fourth video in a series about low risk stock market investing. If you haven't seen the other videos, there'll be a thing up here at the top that you can check it out and see the playlist and watch the other videos. The first video is a complete overview of how we can find very good businesses and then what price we want to be paying for them, and that's a really good video to watch if you haven't watched that already. And there's a couple others in there, one about economic moats and one about growth numbers. If you haven't already, make sure you hit subscribe and let's get into it. So when analyzing the strength of a business, there's four key areas that we want to be looking into. We want to be looking at the economic moat that a company has. What is it and how strong is it? The level of debt in the company. We want to be looking at the ROIC, which is the return on investment capital. And lastly, we're going to look at those four key growth numbers that I went over in the previous video. So first, let's talk about Google's economic moat, whether it has one and how strong is it. So Google, I think, in my opinion at least, definitely has an economic moat that's quite strong. And it comes in a variety of different forms for Google. One of the forms is the fact that the name is used so frequently in modern society. People use it as a verb to describe when they're going to do an internet search. I think every single person thinks the name or says the name Google at least once or twice every single day. And basically what that does is not only does it mean that people are going to be using the Google search engine over other search engines, what it means is that in consumer tech and in other areas, when they see the brand name Google, it's a brand name that they know and it's a brand name that they've heard constantly their whole lives. So they're more likely to go, okay, that's probably a reputable brand. I'm going to buy that instead of this other brand that I've never heard of. One of the most important types of economic moats that I talked about in my economic moat video is in being the industry standard for a product or service that you offer. And Google does this very well in three areas. First, they're the industry standard internet search provider, and that is through their Google search. Secondly, they're the industry standard for online video media through YouTube, and they're also the industry standard for smartphone operating systems that aren't Apple smartphones, obviously, with their Android operating system. Any phone that isn't an Apple phone, any brand, Samsung, LG, most of them use Android operating system. So what they've done is they've established themselves as this industry standard where it's just the automatic. You just go to it. When you want to do a search, you go to Google. When you want to find a video on something, you go to YouTube. So what that means is that it's a brand that's going to be around for a really long time, and you can tell that it's going to be around for a really long time in that way. Another area that Google forms an economic moat is in its cloud services, as it is the second biggest in market share to Amazon. And these are the sort of things you want to look for when you're looking at economic moats. Whether they have big market share, whether that market share is being maintained, increased, or decreasing. And through this, you can sort of hypothesize what kind of economic moat they have and how strong it is. The last thing that I think is really important for whether or not a company has an economic moat is whether or not the founders are still in the company and whether or not the founders are in charge. And the founders of Google, the two founders, are the CEO and the chair of Alphabet, which is the parent company of Google. So that's a really good sign, because what it means is it means that the people who created Google, the people who created this great brand that we're looking to invest in, this great company, they are still in charge. So they're still making decisions. And that's really important, because sometimes when founders leave, the company just goes downhill because the people who created the inspiration are no longer creating inspiration within the company. So I think that Google has ticked the economic moat box. So let's move on to the next one, which is levels of debt. So basically you want to find a company that has very low levels of debt in relation to the amount of assets they have. And the easiest way we can look at this is we can look at it through the current ratio. And the current ratio is the current assets divided by current debts. So that's all the assets that are going to be turned into cash within 12 months, so short-term assets divided by short-term debts, all the debts that are going to be converted within 12 months. And basically you want to see a current ratio that's above 1.5 to 2. I usually look for above 2, however a bit lower is sometimes okay. It depends on the circumstances. But basically the higher it is, the more easily a company is able to cover their obligations, cover their debts if they get in trouble. And Googl's current ratio at the moment is 5.14, which is an excellent current ratio. So what it means is they've got 5 times more current assets, so 5 times more cash, short-term investments, that sort of thing, than the debts that they owe within the next 12 months. And what it means is if there's a significant error in the economy and debt's really hard to come by, it's okay because they've got, I think, $100 billion in cash and cash equivalents on their balance sheet. So they have a lot of money to use to keep the company running while going through hard times, which is a really good sign. The other area we can look at for debt is the debt to equity ratio, which is all the debts divided by equity. And generally I want to see a debt to equity ratio that is less than 0.5. So what that means is, it means there is at least 2 times as much equity in the company as there is debt. And Googl's debt to equity is about 0.3, which is under the 0.5, which is good. So it ticks both those boxes for the debt to equity and the current ratio. So now we've had a look at debt, let's have a look at the ROIC, the return on investment capital. How effectively is management investing our money for us within the company? So basically we want to see, there's a couple of things. We want to see an ROIC that is above 10%. Above 15% is excellent, above 10% is good though. And what you can do is you can go on MSN Money and under the analyst section and under price ratios and then management, I think it is, I'm sure you'll be able to find it. You can find the return on capital, and on MSN Money you'll have the return on capital for the last year and you'll have the return on capital for the last 5 years. And what I look for is, I look for a return on capital over the 5 years that's above 10%, of course, and then I want to see the return on capital for this year higher than the return on capital for the 5 year. So what that would tell me is that not only are they doing, let's say, 10% over the 5 years, they've ramped it up in the last year, and hopefully the closer that we're getting, the closer you're getting to 1 year, the better they're performing as a management team. So for Googl, their return on capital for the 5-year average is 12.6%, which is excellent, and this year's was 7%. However, I do believe that is skewed because of the changes to the tax laws and the fact that they just brought a whole lot of cash over from overseas and paid a huge one-time tax. So that's not really relevant, but the 12.6 is good because that's above our 10% over 5 years. So lastly, we're going to have a look at the key growth numbers. So if you remember in my economic moats video, yeah, we can hypothesize that a company has an economic moat by looking at things like industry standard and that sort of thing. But we need to confirm it in the numbers. We need to see consistently growing numbers in the 4 key areas, which are sales, earnings per share, equity, and free cash flow. So let's have a look at those right now. So we'll start by looking at EPS. So as you can see, the 5-year EPS growth rate, this is compounded by the way, is 14.63%, which is above 10%, so that's great. And the 1-year EPS growth is 14.81%, which is good, because what we want to see is, we want to see that not only is the growth rate above 10% over a period of 5 or 10 years, Alphabet only has data out for the last 5 years, but we also want to see that the growth rate is also increasing over time. So as you can see, it's gone from 14.63% to 16% to 15%. So from 5 years to 1 year, it's still increasing, which is good, which is a really good sign. Now let's have a look at equity. So equity's 5-year growth rate is 16.29%. This year's is 9.7%. So both of those, 9.7, that's close enough to 10. I'm happy with that. You really want to see these numbers growing. So you want to see it to go from like 9 to 16 instead of 16 to 9. But the 16 long term and the 9 current, they're pretty close together and they're not steeply declining. So I'm okay with that. Free cash flow, the long term is 12.45%, which is above our 10%. The 3-year is 28%, which is excellent. and the negative 7% is because of those tax changes. So that's an anomaly, and we won't worry about that. But from 5 to 3 years, it is growing, which is a good sign, and that ticks that box. Lastly, we've got sales. So sales went from 17.3% over 5 years to 19% to 24%, and that's excellent. That's a perfect example of what we want to see across all the numbers. We want to see it going from 5 to 3 to 1 year, all growing and all over 10%. So it's important to remember that you're never going to find a company that has numbers that, like the sales of Google, are perfect for all 4 growth numbers. That's really rare, and if you find that, it's amazing, that's great. But what you got to remember is there's going to be anomalies, there's going to be little errors here and there. Well, not errors, but there's going to be reasons that come up as to why the numbers aren't going to be perfect every year. And one of them is a perfect example here for the free cash flow. The free cash flow went down this year for Google because of tax changes. And it's not that the free cash flow is in any trouble or that Google isn't a good investment. It's just that there's something that we have to do a little bit more digging to find out why that happened. So in summary, Google really did tick the box for most, if not all of these. And I think that we found a really solid company to invest in here. What's important to remember, however, is that the numbers don't always tell the full story. So you can't just look at these 4 areas and go, okay, that's a good business to invest in. You've got to look into the annual reports, and you've got to read the letters to the shareholders. And these are basically the CEO writing a letter each year to its shareholders explaining how the year went, how they think they went, where they can improve, and where they're going in the future. And in these letters, you can really learn a lot about the management of a company. And what you can find out is that whether or not a CEO is being honest with the shareholders. You don't want a CEO who is pitching you. And what I mean by that is you don't want, if the letters to the shareholders really seem like the CEO is trying to sell you, he's trying to sell you something, then that's not a good sign. You want a CEO that is honest. He brings up things that went wrong throughout the year and explains how he's going to fix them, or how they're going to fix them. And that's really important. And if you find anything in the letters to the shareholders that seems like a red flag to you, you should avoid investing in that company. So we've worked out that Google is a good company to invest in. So does that mean that you should go out and buy it? No, not necessarily, because that's only half of how we low risk invest here. We got to find a really good business, which we have, and then we need to buy it at the right price. So we definitely don't want to overpay for a business. Even if it's the best business in the world, if you overpay for it and then it comes back to what it's worth, you're going to lose. So it's really important to find good businesses, make a shortlist, and then go on to calculate the value of each of those businesses. And then we want to pay half of what the value is. So in the next video, I'll show you exactly how you can value a business like Google and how you can work out how much you should be willing to pay. I'll also finish the Google case study, so in that video, I will calculate the value of Google, the value that I think Google is worth, and then I will show you exactly how much you should be willing to pay for that stock, and you can apply that to other stocks that you're researching yourself. So that's it, guys. I hope you enjoyed. Leave a comment, let me know what your thoughts are. What kind of things do you look for in a good business? Leave a like if you enjoyed it, and make sure you're subscribed if you haven't already, and I'll see you in the next one.